You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear.
All right, folks, welcome back to the Shoe In Show. Thanks for joining us. The likelihood that you are, one, dealing with a lot of inventory is very high. And then two, everyone joining us is probably wondering how many shoes we're going to sell this year. And that is what this episode is about. Economic conditions for kind of demand planning, maybe some cost planning too, about how we look at our businesses going into 2023. Got some choppy waters right now. But we've had some choppy waters the last year and a half.
The chop doesn't stop, my friend.
Yeah, whether it's shipping costs or whether it's inflation hit and wages, or whether now it's just kind of trying to figure out where things are headed. So, Matt, I don't know if you're what you're seeing and what you're hearing from executives as we tee it up, but I know we've got Gary, our economist, on today to help kind of flush out some of these narratives for people to think about as we head into spring 23.
Yeah, I think the headline will be, from a sales perspective, we're going to have an epic year in money collected for shoe product. And as Gary, I think, will confirm, we're going to sell less shoes than we maybe did last year, but we're going to collect more money. So inflation's taken that bite. And I think as you talk to execs, I think the expectation is that there's going to be a soft first half of the year. The back half, just depending on how much inflation ebbs and doesn't flow, will be the question. And we know we won't get to 2% anytime soon. And again, Gary can confirm that. But even Jamie Dimon the other day, I saw him basically say, hey, a month ago when I said this economic hurricane's coming, like doom and gloom, we're all going to economically die. I'm not feeling that anymore. So even expectations about how dire things are going to get have been tampered a little bit. Doesn't mean they're not going to be challenging. But needless to say, the chop won't stop. And I think we'll continue to be in this environment where imports are down, demand is down, debt is up. And so, Gary, how that plays on the consumer and the footwear company alike is probably not too difficult to predict. What say you, my friend?
Yeah, it's really been an interesting year in 2022 that, we've seen footwear imports in both volume terms and certainly in value terms increasing just at a breakneck pace. But here in this latest month, as we've been saying, the last couple months, that the imports were due to really slow down markedly. And certainly that's exactly what happened. The volume of shipments coming into the U.S. in November fell at the fastest pace in about 2.5 years, down some 20% year over year. That is the third straight month of declines. But even with this third straight month of declines, year-to-date shipments, again, both in volume terms and certainly in value terms, are up versus the same first 11 months of last year. Of course, suggesting that full-year shipments are set to increase. In fact, in volume terms, while we expect to see a fairly modest increase, in value terms, shipments are due to increase somewhere around 29%. From what we saw in 2021. The problem with that, like you said earlier, is that the amount of consumer spending increase in 2022 is not nearly as robust. Now, over the long term, 24, 25 years or so, year-over-year changes in imports tend to just about match precisely with the year-over-year change in consumer spending on footwear. Well, naturally, it makes sense. As orders, go out the door, more orders have to come in the door. Well, that's not the case this year. We saw that the value of shipments increased at a much faster pace than consumer spending on footwear increased. And I think that's something we've been warning about for some time, that because of that wide divergence between the two, that we were due to see footwear imports needed to decline to return kind of that year-over-year change in annual import increase to the year-over-year change in consumer spending, kind of closer to parity with each other. We're not there yet, but the writing is on the wall that trend is likely to increase with essentially imports, I think, likely to flounder much deeper into 2023. And I think there's not much potential for consumer spending on footwear to increase much faster than what we're seeing this year. If anything, like you alluded to a minute ago, perhaps slow down from the increase we expect to see in 2022.
I mean, would we say a 1% increase in sales is a good year for 23? I mean, I would, based on the headwinds
Yeah,
and the inflation.
I think we're likely to see now. I should maybe qualify this. The change in sales in both value terms and volume terms is what Matt was alluding to a few moments ago. That in value terms, yeah, we're going to see a big increase in 2022. But in volume terms, yeah, it's likely to be a little bit of a decline. So as Matt said, yay, we're selling, we're collecting more dollars on footwear. But the other half of that is no. In volume terms, we're selling fewer pairs.
Yeah.
And as you said, looking at 2023, I think we're still likely to edge out growth both in value terms and volume terms, but I think it'll be a low single digits at best.
Yeah. I think people need to be happy with flat, maybe. I mean, if you look at 2019 to where we are today with the huge increase of revenue for total shoe sales in the U.S. and other places too, we should be very happy we're up, maybe 15 billion, something like that. We're
Yeah,
at 100 billion now.
Yeah.
If we can maintain that and steady it out and not have a huge drop down, I mean, some industries are facing that, right? You look at tech and some other things are having some challenges right now. And obviously, footwear in many ways is recession proof because you have to have shoes. But how many shoes are you going to buy and how many do you need in 2023 as you look at your budget and pay off debt and all the higher bills you have? What, Gary, for inflation, as we look at consumer disposable income and purchasing power, what's that going to look like in 23?
Yeah, I think we're likely to see inflation moderate at a much faster pace in 2023. It's not going to be anywhere near as high as what we witnessed this past year. As Matt said, I do not think the inflation rate is likely to drop back to the Fed's 2% target range. I think that's likely to be a little further over the horizon before that comes to pass. But inflation is going to moderate at a pretty good clip. In fact, we're due to get our next look at inflation here in just a couple of days. And I've already shown some evidence that the writing's on the wall that the near-term inflation prospects are set to slow considerably, and I think that trend is going to continue much deeper in the first quarter. But that having been said, we're not going to come back to 2% inflation in 2020.
Yeah.
Well, I mean, if you going back, I want to kind of touch back on this more dollars collected point, which is all fantastic. The problem is the inventory. If you're selling less, you're holding on to more inventory, and it's not it's not keeping fish fresh or to that extent. But you don't want to hold on to inventory for a long time. That's where the big exposure is, and so you may be collecting more money on less product sold, but you're selling less product, and so you're having to hold on and figure out how to dump that inventory. And in fashion, that's the death knell. That's where the big exposure
right now. That's a big freezer right now for footwear. If you're talking about
exactly footwear. Right, and then what that does is not open up for capital to hire, and so we're going to be seeing, I think, some tightening on the employment side too as demand declines and companies are trying to right size themselves for whatever this downturn is, however deep it is, and whatever the trough is. So I want to make sure people understand that, okay, great, we're collecting more money and 1% up would be great. But if we're not selling as many shoes and we're having to hold on to it, those retailers and those brands are going to have to figure out inventory reduction strategies that get them right size and set to when demand picks back up to be coming out with fresh product and innovative products. So I think that's important to keep in mind during some of these maybe kind of drier times, if you will, with the consumer.
Well, maybe if you can hold it for 20 years, you'll get the cycle back. So if you can hold on those shoes, the styles will come back in fashion. You just got to find your grandma's closet.
Just drop it on StockX and sell it for a premium. That's what you do.
Exactly. To me, some of the big things too is just margin. We look at like total sales, and that's great. But like, when you have inflation and material costs are up, shipping costs are up, it's eating into that. Then you're discounting down. So like, who's going to be successful in 2023 when it comes to actually being profitable? Is this a year where we're just trying to tread water and get to the next year and get through this as an industry and businesses? Or are we actually going to see? I think unfortunately, I think we'll see some losers this year because there's nowhere to hide your losses, meaning capital's not free anymore. It means you can't just take on more loans to cover what you need. You've got to trim somewhere and you got to figure out the stuff. So, Gary, as we look at the broader economy, I think that's really what we're seeing, right? We're seeing capital is expensive now where it wasn't before. I mean, God, we're even talking about like CD rates. Back to the 90s, right? That's the joke. You tell a young banker we need to issue CDs. Number one, they don't even know what a CD is for music, much less dealing with finance. So as we look at that, and people are looking at figuring out their strategies, I don't know your opinion on this, but I just don't think borrowing is where it's at over the next year. I think we're done with that cycle.
Yeah, agreed. The days of the interest rates are gone and not likely to come back really anytime soon. So that having been said, I think we're likely to see low single digit growth in footwear spending this year. And I've said for some time I'm not upbeat on prospects for the broader economy in 2023. I mean, my goodness, going back about a year ago, when the yield curve first inverted, we had kind of thrown up a cautionary sign then that the writing was on the wall that darker days ahead. And I think while we're not going to have an economic hurricane or anything that Diamond had alluded to, I am not upbeat on prospects for the economy in 2023 at all. In turn, that has spillover effects on just about every section of the economy, and certainly on consumer spending on footwear.
Yeah.
Well, how deep is the trough going to be, Gary? I mean, you've shown time and time again on the unemployment side, and there's a number of variables that show historically we're going to hit a recession. One is the unemployment rate is rock bottom, and so how deep? If it's not an economic hurricane, as Jamie Dimon said last year, but it's something south of that, but still dramatic. I mean, what do you think the trough looks like relative to a recession, and then when do we start kind of coming out of it?
Yeah, what's the old joke that economists have forecasted 9 of the last 7 recessions?
Sounds right.
Yeah, there's still a bit of that going on now, and I see, I read reports from colleagues in the industry all the time, and the numbers are all over the map. You said prospects for a softer first half of the year, and then maybe rebound in the second half of the year. Diamond had said a couple of weeks ago, of course, this hurricane, and now he's kind of tempered some of his pessimism a bit. The numbers are still all over the map. I do not think we're likely to see this proverbial soft landing that you're talked about. I think the number is a little too out of kilter to have the Fed to engineer a soft landing by increasing rates. I do think rate increases are going to taper off substantially and may even stop toward the second half of this year. But as far as how much of a trough are we looking at for in terms of the economy, I think it's going to be a modest recession. It's not going to be near the the calamity we saw in 2007, 2008, or near as steep as what we had witnessed back in 2020 in the early days of COVID. But I do think prospects for a recession seem to grow brighter, louder, every day.
Yeah, I would go with that too. I mean, if you had asked me in the fall, I think I would have had a completely different opinion on what might happen in 23 with the economy. But I mean, I think the biggest thing is just the job numbers tell us so much, because if your unemployment rate goes up, that means those people are utilizing government services to make payments for, basic needs and debt. And as long as people are employed, they have leverage at some point. They still have income where they can cover that. They're not quite in a hole. Mm-hmm. But the more that ticks up, the bigger problem we're going to have with our economy. But it's holding. That's the strange thing, is it's holding right now. And I think what Gary's right. I think if you have the example of a sheep, are we going to have a slaughter? Or are we going to have them trimmed, right? We have a shave. And I think it's more of a shave than a slaughter compared to what I was thinking about last year. And I don't think it has anything to do with the Fed. I don't want to give them any credit whatsoever. They had complete misses to start with. I think they talk about how they have a scalpel for the economy. They don't. They have blunt instruments. Their balance sheet is way bloated. I think if they would have reduced their quantitative easing from 2008 over the past decade and actually tapered it down, we'd be in a much better shape. My guess is what might happen, and Gary, you can chime in too, but when you start to see the economy go a little bit down and they're trying to soft land it, my guess is they'll stop the rates and they'll start quantitative easing again, buying up different assets again to try to get it there. But that's only going to that's a self-made Fed bubble in many ways, and I just don't know how we get out of that cycle. But that's, in my opinion, probably what we'll see in the summertime is like more purchases from the Fed when they should have offloaded all that stuff in like 2010, 2012. They just didn't.
Yeah, I would agree that the Fed's main policymaking tool is absolutely a blunt object. It is not a scalpel at all. It's more the sledgehammer. And as I've argued for some time, the Fed was late to the party to take away the proverbial punch bowl. They should have. I agree. They should have begun siphoning the punch bowl much sooner than they did. Once they did decide to do this, there was no siphoning to it. They yanked the whole punch bowl away, and of course we saw rates begin to increase at really the fastest post-war pace on record. So I think that the Fed does risk overshooting. One could argue that they had kept rates too low for too long, essentially too much stimulus too long in the economy.
Yep.
And I think now they've kind of realized this, kind of awoken to it, and they risk overshooting in the other direction. And I think it's likely to be a Fed unintentionally engineered recession because of that.
Well, let me put a few points out there, and I'm not a Fed apologist by any stretch. I do have empathy for policymakers who are facing an environment where you had $2 trillion dumped on the American population. And it's hard to forecast what that impact is and then make sound policy decisions on the fly. It's easy to Monday morning quarterback. And the quantitative easing is absolutely right relative to the ramp up to in the 2010s to unloading some of that. I guess no one ever imagined we'd be in an environment where Congress in a very short amount of time would give $2 trillion. And they probably did too much too quickly, to be honest with you. And so I think there's just a lot of intrepidation from policymakers as to how much pain to inflict and when to have done it. And none of it would have been probably correct in anybody's eyes. But at the end of the day, my interest is actually what the impact is on the shoe retailer. And so the irony, or the interesting part, I should say, about the timing of this so-called forecasted recession is the fact that it's going to run up right as we're right in the middle of about tax refunds start to go out. And if you ask any of our retail execs in the family footwear space, they talk about the impact those refunds have on the movement of product and the purchasing of product. And so we're going to be entering into that season here very shortly. And so talking to several retail CEOs in our space, they're actually a little bit optimistic about what that means to kind of bridge some of the gap, is that there's going to be that injection of cash from refunds that will help kind of goose the footwear consumer in the U.S. that allows to move some of that inventory that people are talking about. On the flip side, Andy received some intel from someone who's in Asia right now from one of our brands, and they're just talking about the pre-Chinese New Year run on production is not happening this year, which typically happens every year. And so, Gary, to your point, there's just a lot of different variables and data points that are speaking, past each other and speaking in opposite directions for us to have any kind of real wisdom as to what we think could possibly happen.
Yeah, it's a good point. I said earlier that in November, the shipments had fallen, a little south of 20% year over year, and of course that was November. That was before we saw many of these Chinese lockdowns due to the spreading of COVID. And that has me concerned that on the supply side, that you're likely to see a whole lot less shipments, particularly from China, in coming months. So I think that is something that's going to spill over much deeper into 2023. Typically you don't have to worry. I say worry. You don't have to worry as much on the supply side. You want shipments, you can get shipments. It's the demand side that is the business there to warrant those shipments. Now you got to worry about the supply side and the demand side, like we really haven't had to in recent memory.
Yeah, and the material costs are down. The U.S. dollar's down against other currencies, which means that when that happens, it's typically commodities are moderating. So I think for cost planning, as Gary said earlier, like the inflation across the supply chain is definitely going to dip from what it was. How much you're going to get from your supplier is up to your good negotiation skills about how lower you can get them in line with that. Because they're still, I think, trying to recoup their losses from the COVID era. So that's a different conversation. But no, it's, Q1, Q2 is going to be very choppy. Let's see what happens Q3, Q4. I wasn't trying to disparage the Fed because I did the Fed Fund Challenge when I was in high school and respect them very much. I just have a counter idea that even a guy from West Virginia, Senator Manchin, knew that if you add too much money to the economy, inflation is going to spike. So I think any economist in their right mind was probably concerned about what was happening with the economy during COVID, but the solution maybe wasn't $2 trillion, maybe it was $1 trillion. But you throw $2 trillion out into the marketplace for free money.
Don't be cheap, Andy. Only $1 trillion wasn't going to do it. Don't be cheap.
Well, maybe, but I'm just saying. Hey, listen, the Fed Reserve missed it, and the guy from West Virginia who's mining coal got it. So you go figure that out, right? But I don't know. If you look at the market, I think the winners know their customer in 2023, and they know what they have in their closet, and we're going to get through this inventory glut and all these issues, and hopefully we see new product coming out in Q3, Q4, and I think that's going to be the saving grace, and the successful people will be the ones who invest in those optimizations at the retail and direct consumer that, again, know their consumer, speak to their consumer, know the price points that they can sell the product at and move the product. Because I think that, Gary, we can talk about this too really quickly, but the elasticity of price and demand it's like a rubber band snapping back and forth in many ways. That how do we get the pricing right in this market when we don't even know how much, not just our inventory, but total inventory are out there and what's going to move and sell, right?
Yeah, you're right. As I said earlier, we're seeing that imports are increasing in 2022, increasing much faster than demand, which typically would suggest lower retail prices. But that hasn't been the case this year at all. Last year rather at all. That we saw that footwear prices had increased at the fastest annual rate really in decades. And I think talking elasticity, I think there's likely to be some snapback from that as we see inventories look to right size to match that lower level of growth and demand.
But Matt, the only way to get your pricing back to level is new product. There's no other, what we were hearing from someone at December Fannie was, unless they see 40% outside the door, they're not going to walk in. So I just don't know another way that you drop your prices 20 or 30% and then think they're going to go back to level at some point with same products.
Well, we did that for a decade, so it's
physically impossible.
It's well-known territory, my friend. I remember when things were like being sold at full price with no markdowns at the height of the demand spike post the start of COVID, and people are like, "What is this? We're not used to this." And so I think it's like Back to the Future, to be honest with you.
Yeah. Yeah. During COVID, all the companies fired their discounting expert, and now they're going back to find them again.
Exactly.
Jimmy, come back.
Where's the guy printing 40% off signs? Bring him back.
We're never discounting again. We've got it right. Now, what happened to Jimmy? Did he retire?
Yeah.
We need to figure out the incentive bonus. You don't have to come in. No. Stay at home. No problem. Gary, before we head out, is there anything else that we didn't discuss, or something you want to put on people's radar?
Oh my goodness, the hits keep coming. It seems, as you said, talking about the dollar, I think the dollar is going to be a key driver of commodity costs much deeper into 2023. We've seen the dollar retrench from its 20-year high back in September, October or so. And I think as the dollar tends to weaken, it tends to strengthen commodity costs. We haven't seen much of that spill through just yet, but certainly that's something we're going to be keeping a close eye on if the dollar does continue to weaken deeper into the new year.
Yep, that greenback. And as we wrap this up, as we talk about this, if you're an FDRA member, every Tuesday we cover this stuff. Anything that pops out, could be jobs report, could be retail sales reports, could be price report. We track anything and everything that impacts the footwear industry and your business. So Join us at 2 p.m. every Tuesday, 2 p.m. Eastern time. You can sign up on our website, FDRA.org, to get these quick hits from Gary. And I'll remind people too, I was doing a member review with a company the other day, and I reminded them we can crunch numbers for you individually as well. So if you want to get on the phone and hear anecdotal information that we have, or look at something particular in the market, if we can get to that, we never give out bad data. But if you're looking for something more specific and more niche, we can try to get down to the nitty gritty for you to help you make better decisions as you go through this. But lean on FDRA during these rocky times, and hopefully we can all get out the oars and paddle together in the right direction out of the storm. I do think, on a bright note, the end of the year will be quite good. I think psychologically people will lock down a little bit, but I think come fall, I think we'll be okay. So, and that's better than what maybe we had said last fall. So, good news, some bad news, but hopefully by this point, Matt, we've built up endurance to deal with some of the storms we've had and some of the hurricanes and everything else.
If not now, we will never build up endurance,
exactly.
my friend.
Right, exactly.
If not now, when?
Well, it's better to be busy than bored. So with that, keep busy, and Shoe-In is out.
Shoe-In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.